So, in today's class, I'll be discussing the 2024 A-Level Part 1 paper. I'll start off with the first question. Which of the following statements best describe the primary purpose of financial accounting in a firm? Okay, now when it comes to financial accounting, the main purpose is to provide information to stakeholders for decision making. Okay, now stakeholders as in both internal and external stakeholders. Okay, but then out of this both internal and external stakeholders, whom do we mainly focus on? We mainly focus on the external stakeholders. So if there is no answer that says we provide information for both internal and external, you can go with the answer that says it provides information to external stakeholders. Okay, now here that's the fifth answer. Provides the information for the decision making of the external stakeholders of a firm. So answer number 5. Now, if you are to look into the other answers, reports pass financial information of the firm to satisfy statutory requirements. That means legal requirement. That is a sub-objective. Sub-objective of financial accounting. Records the transaction of the firm to prepare general purpose financial statement. This is the process, not the purpose. Provide specific purpose, that's about management accounting. Management accounting. Prepare general purpose financial statement of the firm based on the accounting standards. Again, that is a process. So the answer which provides or the best describes the primary purpose of financial accounting is the fifth one. Provides information for the decision making of external stakeholders of the firm. The second one, a firm is unable to continue its operations for the foreseeable future. Which of the following accounting concepts are not relevant in preparing financial statement of this firm? Now, the main assumption of a business is what? The main assumption of a business is going concern. What does going concern mean? We are assuming that our business will run for a foreseeable future. We will operate our business forever. Okay. In that assumption only, we are dividing our assets and liability as current and non-current. Whatever the assets that will be there in the business for more than a year, we classify as non-current asset. Whatever the assets that will be there in our business only for a short period of time, less than a year, we classify as current asset, and same goes with current liability. Now, if the business is unable to continue the operation for the foreseeable future, if we can't continue our business forever, if they tell like that, that means we are able to continue our business only for a short period of time, maybe for less than a year. Then if that is the case, going concern concept, you don't have to follow. You don't have to classify your asset as current and non-current, liability as current and non-current, because you can't continue beyond a year, right? There is no foreseeable future in your business. Then all your assets will be classified as current asset. All your liability will be classified as current liability, because by the end of this year, you have to sell all those assets and settle all those liability and close your business because you have no ability to continue. So you all know going concern concept is not relevant if there is no foreseeable future. With that, you can take the third one is the answer. But then, why is historical cost not relevant? The reason behind that. Now, I'll ask you all a question. Okay. If you're not able to run your business forever, okay, you're not able to run your business forever. Okay, you will have to shut your business down by the end of this year. Then all your assets will be current assets, right? Why is it being current asset? What will you do to those assets by the end of the year? Can you all give me an answer? If you're not able to continue your business, okay, and you classify all your assets as current asset because of that, what will you do with those assets at the end of the year? When you're ending your business, what will you do with those assets? You will sell those assets, right? You will sell those assets. Okay, there's no, you won't be keeping it with you anymore. By the end of the year, when you're ending your business, when you're shutting down the business, you will sell those assets. Now, when you're selling those assets, will you sell it at the original price you purchased at, or will you sell it at the current market rate of that asset? You will sell it at the current market rate of that asset. Therefore, when you're classifying all those assets as current asset, even your non-current asset, you will not record it at the cost. Instead, you will record it at the fair value. Therefore, historical cost is also not relevant when there is no foreseeable future. So the answer is the third one. Hope you all got that. Okay. Then the third one. Which of the following statement is are correct as to the application of business entity concept? A. All the transactions of a business are recorded from the perspective of business. Correct. We record all the transactions from the business perspective, not from the owner's perspective. This concept provides the basis for identification of reporting entity. Correct. Reporting entity means any entity that is obliged to prepare financial statement. Based on the business entity concept only, we will find out who are reporting entities. See, the owner's investment in a business is presented as a claim to the resource of the business. Now, asset equals equity plus liability. When the owner invests something to the assets of the business, it will be a claim of resources. That means it belongs to the owner. Whatever the owner invests, that belongs to the owner. Owner can claim whatever he invested. So that is also correct. So all A, B, C, answer number 5. Then the next one, use the following information to answer questions number 4, 5, 6, and 7. Okay. Fourth one, which of the following accounting equations reflect the net impact of transaction number 1 and 2? So we'll prepare the accounting equation asset equals to liability plus equity. So the first one, sold goods costing 240 to Amal for 554. So inventory minus 240 under asset, debtor plus 354 under asset, and this includes a VAT of 54,000. So that VAT will go to liability plus 54. So here totally your debtor increased by 354. That includes the VAT of 54,000, which means your selling price is 300,000. Okay, the selling price is 300,000. The value of the inventory is 240,000. Therefore, there is a profit of 60,000, equity plus 60. Then, second one, received a check from Amal to settle the total due amount after allowing a cash discount of 30,000. Now, Amal had to pay us 354. Now, he's settling that entire amount. Then, debtor minus 354. He is settling this amount after receiving a discount of 30,000. Therefore, equity minus 30. Then how much are we getting in cash? He has to pay us 354. We are giving him a discount of 30. That means we are getting cash 324,000. Then what is the net impact of all these transactions? 84 plus 54, 30. 84, 54, and 30. That is answer number 1. Then the fifth one, the source document used to record the transactions number 3, 4, and 5 in the books of Chandra's business in the order of their occurrence. 3, 4, and 5. Now this is Chandra's business. They are asking what are the source documents to record 3, 4, and 5 in Chandra's business. Third one, sold goods costing 320,000 for 472,000 on cash. So you are receiving cash there, soft document is received. Fourth one, sold goods costing 400,000 to Bimal for 590,000 on credit. That is a credit sale. It will be invoice. Fifth one, return goods sold to Bimal. Sales return. Sales return, the soft document is credit note. So receipt, invoice and credit note. Receipt, invoice and credit note. That is answer number 2. Then the sixth one. What is the correct double entry to post the total of sales journal? So sales journal is all your credit sales, right? So double entry to post the total of your sales journal will be debtor debit, sales credit, and VAT amount credit. So we'll figure out what are our credit sales here. The first one is a credit sale, and again the fourth one is a credit sale. Then how do you record that? Sold goods costing 240 to Amal for 354. Then debtor will increase by 354. Out of that, the selling price is 300, the VAT amount is 54. Then the fourth one, sold goods costing 400 to Bimal for 590, including 90,000 VAT. Then again, your debtor will increase by 590. Out of that, the sale value is 500. The VAT amount is 90. Then total debtor value will be 354 plus 590, 944. 354 plus 590, 944. The sales value is 800, VAT value 144. So debtor debit 944, VAT credit 144, sales credit 800. That is answer number 3. Answer number 3. Then the seventh one, the VAT control account and debtor control account balance. So we'll prepare a VAT control account. VAT control account and debtor control account. Okay. So first of all, the first and fourth we can record it together. Both are credit sale, right? So here debtors will be debited by, you can say, sales 800, VAT 144. VAT control will be credited. You can say debtor 144. That is transaction 1 and 4. In transaction 2, received a check from Amal to settle the total due amount after allowing a cash discount of 30,000. So how much will we receive from Amal? We will receive 324. We found it out. So cash 324, discount will be 30,000. Discount 30,000. Then second one recorded. Third one, sold goods costing 320 for 472 on cash, including 72,000 VAT. So that will affect the VAT control account. You can say cash 72. 72. And then the last one, return goods sold to Bimal for 118,000, including 18,000 VAT. The cost of these goods were 80,000. Okay. So return goods sold to Bimal, that will be credited to the debtor control account. So return and the return VAT amount. The selling price of the return good is 100 and the VAT amount is 18. And then that 18 VAT should be debited to VAT control account, debtor 18. So now you can balance off your debtor control account and the VAT account. So 944, 944 minus 324 minus 30 minus 100 minus 18. That will be 944 minus 324. Give me a minute, I'll tell that. Wait. Which 90? Oh, sorry. Yeah. Oh, no. Okay, wait. Here I added both the VAT together and I put the first the first credit sale, the VAT is 54,000. In the fourth one, the VAT is 90,000. I added both together and I put as 144. The total VAT from credit sale 144. Is that clear? Okay. So BCD will be 472. All right. Then the VAT account 144 plus 72, 216. 216 minus 18, that is 198 BCD. So if the BCD is in the debit side, the BBF will be in the credit side. Here BBF will be in the debit side. Okay. So the VAT control account balance is a credit balance of 198, debtor control account debit balance of 472. That is answer number 4. Why didn't I enter the fourth transaction? I entered it. Here, what I did was, now here, first one and fourth one are credit sale, right? First and fourth are credit sale. Now we already, in the sixth one, the first and fourth, we added and got the values right. So what I did, that same amounts, this is the first one and the fourth one together, I entered those amounts here. The total credit sale 800, from the first and fourth transaction. The total VAT amount 144 from the first and fourth transaction. I put it to the VAT control. Okay. So these are the combination of the first and the fourth transaction, both of it. Okay. All right. Then moving on to the eighth one. The net profit as per the draft financial statement of a company for the year ending 31st March 2024 was 5 million. So they have given a drafted draft net profit of 5 million. Okay. They're asking the corrected net profit after correcting the above errors. The total of the sales journal, rupees 8,500,000 has been posted to the general ledger as 5,800,000. So here the sales is undercasted by 2,700,000. So sales is an income. If that is undercasted, you have to add it. Sales 2,700,000. Second one, sales commission payable rupees 450,000 has been debited to sales account and credited to sales commission payable account. What will be the double entry for sales commission payable? Sales commission payable, the double entry will be sales commission debit and sales commission payable credit. But what they have done, without debiting it to sales commission expense account, they have debited it to the sales account. Then how do you correct this? You have to remove it from the sales account. So sales account credit, they have debited it, they have deducted from sales, then you have to credit it and you have to debit it to the sales commission account. So here our sale is increasing, sales credit means sale is increasing by 450. On the other hand, expense is increasing, sales commission you have to deduct the sales commission expense. So can you all tell me, due to this second error, was there any effect to the profit? No. Okay, there is no effect to the profit because of that transaction. No impact. Okay, then the third one. A bank loan installment of 850,000 has been paid and it has been debited to the bank loan account and credited to the cash account. However, the interest of 150,000 included in this installment had not been recognized as a expense. Okay, so you have to record that bank loan interest 150, 150. Okay. Okay. Kashu, right? Okay. Here, why did I add and minus? First of all, did you understand this part? How I corrected that error? Is that clear? Sales commission account debit 450, sales credit 450. Okay. Now see here, sales commission debit. You know, right? If any income or expenses, any income or expense debit, you have to deduct from your profit. You have to deduct from your profit. If any income or expense is credit, you have to add it to your profit. Okay. Sales commission is a expense. Here, sales commission is debited. If any income or expense debit, you have to deduct from your profit minus sales commission 450. On the other hand, sales is credit. Sales credit 450. So your income is increasing. You have to add that again. Sales 450. So due to this transaction, there is no any impact on your profit. Okay. Did you understand that? Okay. So now I'm going to teach you something new. New means there's a change I've seen in the 2025 marking scheme. Can you all tell me the double entry to record this bank loan installment? You all tell me, how have you all learned so far? We have been learning it differently, but then there has been a change. What's the double entry to record the bank loan installment? Hmm. Okay. So earlier we have studied like this, right? Bank loan debit. Now here, how much is the loan amount? The installment is 850, interest is 150, then loan amount is 700. Interest amount is 150 and cash will be credited by 850. This is how we have learned it. Give me a minute. Sigma, I can't see that image properly. It's not showing. Yeah, Sigma, that the answer is the fourth one. Yeah, the answer is the fourth one. Okay. All right. So here, but now how do we do that? Okay. Um, Now how it's done? Bank loan debit, bank loan debit 850, cash credit 850. You debit the entire installment amount to the bank loan account And after that, you remove the interest from there. Just like how we do leasing adjustment, the bank loan account will look like this. Bank loan, BBS. Then you will debit the entire installment amount. That will include the interest. Then to remove the interest, you will credit it. You will credit the interest to the bank loan account. Then what will be the double entry to record the interest? That will be interest expense debit, bank loan credit. Did you all get it? Okay. Now the double entry has to be recorded like this. I didn't understand. Okay. No. So okay. Wait. Now this is for the prime entry book. Okay. Wait. Now when they just ask the double entry, you can write like this to record the installment. Okay. Wait. No, sorry. I wanted to explain this in prime entry book. Okay. Now when they just ask the bank loan installment double entry, you can say this. Bank loan debit 700, interest debit 150, cash credit 850. Okay. But when you all are recording in prime entry book, normally we divided, right? The loan amount goes to which column? Loan amount goes to which column in the analysis? Cash receipts analysis. To which column will the bank loan amount go to? Bank loan amount goes to the other column and interest amount goes to the interest amount used to go to which column? Not income. It goes to the expense column, right? Expense column. But now, okay, in the 2025 marking scheme, there was an update. What they did, the entire installment amount they put to the other column. Okay, the entire installment amount they put to the other column. That means they are debiting the entire installment amount to the bank loan account. Okay, you all know how to do the lease interest adjustment, right? We will have the opening loan, just like that. Bank loan, opening balance will be there on the credit side. The total installment amount, yeah, that's what I'll tell. The total installment amount you will debit. This installment amount includes the interest, right? The interest, to remove that, you will credit it. And then what you will do, you will credit it to the bank loan account and debit it to the interest expense account. Then where will you record this? In which prime entry book will you record this adjustment? Interest expense debit, bank loan credit. In the general journal. Okay. In the general journal. You look into the 2025 marking scheme. This is how they have done. They have put the entire bank loan installment amount under the other column. And in the general journal, they have done the adjustment for the interest. Okay. That's some additional information I gave now. We will study that again in 2025 part 2 paper. Okay. So then what is the corrected profit here? 5,000 plus 2,700 plus 450 minus 450 minus 150, 7,550,000. Answer number 3. Answer number 3. Okay. Ninth one. Yes. It is a double entry. In which prime entry book will you record that? In the general journal. Okay. During the year ending, yes, two entries. Yeah. Here, dual entry means double entry, debits and credits. Okay. That doesn't mean there is only two entries. Okay. During the year ending 31st March 2024, yes, sure. Yeah. Okay. During the year ending 31st March 2024, the owner of the business obtained goods costing 56,000 as drawings. No adjustment has been made in this respect in the books of account. However, the closing inventory has been certain based on physical stock available. Okay. The gross profit and net profit of the business has been calculated as 250 and 120 respectively. So gross profit and net profit. Gross profit 250, net profit 120. Now, Here, owner's drawings of 56,000, they have not recorded. Now, if you record it, will it increase your gross profit or decrease your gross profit? The owner's goods drawings, okay, when the owner withdrew goods and the stock is counted, the closing stock is counted based on the physical stock, then you have to deduct the goods drawing under cost of sale. So if you deduct the goods drawing from your cost of sale, your cost of sale will reduce. And if the cost of sale is reducing, your gross profit will increase. Therefore, you will add it to your gross profit. Gross profit plus 56. And now, because your gross profit is increasing by 56, automatically your net profit also will increase by 56. Whatever affects the gross profit will automatically affect the net profit as well. Therefore, what's the answer? 306 and 176. That will be answer number 5. Then the 10th one. The information given below relates to trade debtor of Aurelia Enterprise. Bad and doubtful debt, carrying amount of trade debtor. Okay, I'll prepare a debtor's account. And a bad and doubtful debt account. Bad and doubtful debt account. Okay. The credit balance of allowance for doubtful debt account was 70,000. BBF 70,000. Trade debtor before adjusting for bad and doubtful debt 1,050,000. BBF 1,050,000. Rupees 50,000 receivable from a trade debtor has been written off as bad debt. Then you will say here bad debt 50. And what you can do now, here they are asking for the bad and doubtful debt expense, right? So you can combine the bad debt and doubtful debt account as one and prepare a bad and doubtful debt account. Then here debtors account debit, you can credit it, debtors account credit, you can debit it to the bad and doubtful debt. Bad debt 50. Okay. The firm decided to make a 4% allowance for doubtful debt on trade debtor balance as at 31st March 2024. Now, what will be the closing debtor balance? Closing debtor balance will be 1,000, 1 million, 1 million. Then how much is 4% of 1 million? 4% of 1 million is 40. Then the closing bad and doubtful debt balance will be 40. Okay. So closing bad and doubtful balance, you will figure it out by multiplying this allowance amount with the closing debtor balance, right? 4% of 1,000 is 40. And when you balance off, you can find your bad and doubtful debt expense to show in the income statement. 90 minus 70, that is 20,000. Then how do you find the carrying amount of debtor? Debtor account closing balance 1,000. From that, if you deduct your doubtful debt provision of 40, you can get your carrying value of debtor as 960. So bad and doubtful debt expense 20, carrying amount of debtor 960. That is answer number 1. Okay. Then the next one. Use the following information to answer question number 11 and 12. The following balances have been extracted from accounting records of Mihirani Enterprises. What are they asking? Total manufacturing cost and cost of sale. Okay. Manufacturing cost, how you can find? Opening raw material. Opening raw material is 60. Opening raw material 60. So that you have to add your purchase of raw material. How will you find the purchase of raw material? You can prepare a creditor's account. Here, all the raw material purchases are made on credit. So, creditor's account. Opening creditors balance is 20. Closing creditors balance is 15. Cash paid to creditor is given as 150. And when you balance off, you will get your purchase as 145. So raw material purchase 145. From that, if you deduct the closing raw material is 45. You can get your consumed raw material. Consumed raw material. Consumed raw material will be 160. Then you have direct labor cost. Okay. You have your direct labor cost as 300 and production overhead cost paid amount. Here they have given the production overhead cost paid amount as 75. And also here you have to find your depreciation. There were no purchase or disposal of machine during the year. So at opening date, your machine value is 800. At closing date, the carrying value of your machine decreased to 675. Then what will be the depreciation? 800 minus 675. That means the depreciation value is 125. So depreciation of machine 125. Then you can find your manufacturing cost. 160 plus 300 plus 75 plus 125. Manufacturing cost is 660. That is answer number 4. The next one, to find the cost of sale. Cost of sale will be opening finished good plus opening finished good is 120. For that you have to add your production cost. Production cost is 660 and you deduct the closing finished goods. Closing finished goods 160. You will get your cost of sale as will be 620. Answer number 4. Okay. Then 13th one. Which of the following statements are correct as per section 24 of the Partnership Ordinance? Okay. The partners are entitled to share profit and losses equally. Yes. As per section 24, you have to share profit and loss equally. Then the partners involved in the administration of the partnership are entitled to receive a remuneration. That means a salary? No. As per section 24, they are saying partners should not get a salary for working in administrative purpose of the business. See, the partners are not entitled to receive an interest on capital. Correct. The partners are entitled to reimburse if they have spent personal funds for business activity. Correct. If the partner used their personal money for the business purpose, they have the right to get it back. That is what reimbursement. So they are asking for the correct statements A, C, and D. A, C, and D. That is answer number 4. Answer number 4. Okay. Then 14 and 15. Profit of the partnership and equity of the partnership. Okay. So capital account, current account. To find the equity, so then capital account, Anil and Banu, right? Anil and Banu. Current account, Anil and Banu. Okay, they have given the opening balances here. You can say BBF 6,000 and 5,000. Current account BBF 800 and 600. Anil and Banu are carrying out a partnership, sharing profit and loss equally. As per the partnership agreement, each partner is entitled to an annual salary of 1,200,000. So in the current account, you can say salary 1,200,000, 1,200,000. The following opening balance were recorded. During the year, Anil and Banu contributed 600 and 400 respectively as additional capital. So additional capital you can put to capital account 600 and 400. Okay. Then further, during the year, each partner has taken 1,000 in cash from their salary. So salary paid, you will deduct. Salary paid 1,000. Okay. The profit share of each partner was 300 for the year. So that you can put to the current account. Profit share 300. Okay. Now you can find their closing balances 6,600, 5,400. Current account, this is BCD, you call it BCD. Anil 800 plus 1,200 minus 1,000 plus 300, that is 1,300. Then 1,100. Okay. Now, first of all, the profit of the partnership. How will you find the profit of the partnership? Profit of the partnership equals partner's salary plus interest on capital plus profit share plus profit share. So salaries of partner 1,200 plus 1,200, that is 2,400. There is no interest on capital here. Profit share 300 and 300, that is 600. And the total profit is 3,000, 3 million. 3 million, that is answer number 5. Then the equity of the partnership. Equity equals to capital account plus the current account. The total capital account balance of Anil and Banu is 6,600 plus 5,400. That is 12 million. The current account plus 1,000 is equity will for n. Okay. You can see the screen, right? All right. So yeah, 16th and 17th. Total comprehensive income will be equal to total income minus total expense. So here they have given cost of sale. Cost of sale is an expense. Cost of sale 6,500. And they have given the gross profit. Then can you all tell me what will be the sales income? What will be the sales? Sales minus cost of sale will give you gross profit. Cost of sale is 6,500,000. Gross profit is 3,500,000. Then how much will be the sale? Sales will be 3,500,000 plus 6,500,000. That is 10 million. 10 million. So you can say under total income sales 10,000. Okay. Then other income you can put to income. Other income 1,600. Wait here. Then you can see here. Profit for the year. Profit for the year is given. Profit for the year 2,200. Then how much will be the operating expenses paid? How much will be the operating expense? If profit for the year is 2,200,000, And the gross profit is 5 million. Ah, no, no, wait. You have to add the other income as well. Give me a minute. Gross profit 3,500,000. Okay. You will have to read this a bit. The machine have been revalued for the first time on 31st March 2022. Okay, that means long ago, and had resulted in a surplus of 450. The motor vehicle have been revalued for the first time, and the machine have been revalued for the second time during the current year. Then this entire motor vehicle surplus should go to other comprehensive income, right? It's the first time revaluation surplus. Okay. And the machine have been revalued for the second time. Okay. For 800. Machine has been revalued for 800 for the second time, and there is a deficit. Okay. And there's a surplus first time, then you will have to set off 450 under other comprehensive income. In comparing the profit for the year, the revaluation surplus of motor vehicle 1000 has been included under other income. Do we put the surplus under other income? Surplus goes to other comprehensive income, right? Then your other income to put in the P&L will be 600, not 1600. Other income should be 600. So you can say other income 600 and show the surplus separately. Motor vehicle surplus 1000. For your working, you can just put it. But then here your profit is given as 2,200,000. Okay. But the other income they have calculated is 1600. Then what will be the operating expense? Now, why I put the wrong other income is because they have calculated profit by taking 1600 as other income, right? So the profit is also wrong here. But then what will be our operating expense amount? How much will be our operating expense amount? That will be 2,900. So you can go to expense and say operating expense 2,900. And then the revaluation deficit for the year, you can put under expense machine deficit 800. So then your total income and total expenses would be 10,000 plus 600 plus 1,000, 11,600. And total expense will be 6,500 plus 2,900 plus 800, 10,200. This is your total income and expense. Then your total comprehensive income will be 11,600 minus 10,200. That will be 1,400. Now you can divide the total comprehensive income as other comprehensive income and profit after tax. Okay. Now this motor vehicle is a first time revaluation. So the entire motor vehicle surplus you can record under other comprehensive income. The machine, last time there was a surplus of 450. This year there is a deficit of 800. So from the last year's surplus, you can set it off under other comprehensive income, 450. Then what will be your other comprehensive income? 1000 minus 450, 550. Then out of your total comprehensive income of 1,400, if 550 is your other comprehensive income, what will be your correct profit? Your correct profit amount will be 850. 850. Correct. So then profit for the year will be, wait, what happened? Cost of sales 6,500. Operating expense 2,900. Here see, the revaluation deficit of the machine, rupees 800,000, has been deducted entirely in computing the profit. So they have deducted the entire 800 when calculating the profit. Okay, then this operating expense includes the deficit of 800. Okay, then if the deficit is 800, you don't have to show that separately. Okay. Yeah, this is a new type of question. I mean, a bit complicated where you need to read everything to do the question. Okay. So the total expense will be, you have to change that. Cost of sale, operating expense. Then you can say total expenses are 6,500 plus 2,900, that is 9,400. Then what will be the total comprehensive income? 11,600 minus 9,400, that is 2,200. Then 2,200 minus 550, profit will be 1,650. Then profit for the 1,650, other comprehensive income 550, answer number 1. Can't we simply add 850 and 800? Add to what? What is 850 and 8? Okay, yeah, 2,200. So you can find your profit this way also. Here they have given a profit of 2,200. Wait, here the profit they have given is 2,200. Okay, from this they have recorded the revaluation surplus in other income. You can deduct revaluation surplus 1,000. You can deduct it, and they have deducted the entire revaluation deficit in when calculating profit, right? But 450 goes to other comprehensive income. So 800 minus 450, you can add 350 to the deficit. You can add it to the profit. Then the corrected profit will be 2,200 minus 1,000 plus 350. That is, wait, 1,550. 2,200 minus 1,000 coming as 1,550. Wait. No, sorry. Yeah, 450, right? The 450 goes to other comprehensive income. So you have to add the 450 here. 1,650. Okay. So then 1,650 is your profit. Other comprehensive income 550. Total income 11,600. Total expense 9,400. Answer number 3. Can't we add 850 and 800? Where is 850 and 800? This one, right? Now here I got total comprehensive income as 2,200. Okay, for that, now we found OCI as 550. Then when deducting the OCI from the total comprehensive income, I got the profit after tax. 1,400 minus 550. 850. Incorrect profit, and they are saying an error 850. No, sir, that was a mistake I made, right? Not a mistake they made. Right? The 1,400 That was my mistake because I put the revaluation deficit again, but it's already deducted. So you don't have to double count it, right? It's already there in the operating expense. I have put it earlier twice. Okay, that's what there was extra 800 there in expense. Okay, 18th one. The following transactions have been occurred in Sachin PLC during the year ending 31st March 2024. What are they asking? The amount of net cash inflow or outflow from investing activity. Okay. Purchase of machine is the outflow. Purchase of machine. Purchase of machine. Purchase of machine 2000. Sold office equipment, that's the inflow. Sold office equipment. Sold an office equipment with a carrying value of 3600 at a gain of 600. The carrying value of the office equipment is 3600. You're selling it with a profit of 600. Then for how much are you selling it? You're selling it for 4,200,000. Obtain the right of use motor vehicle under a lease agreement. The cost of the right of use asset is 4,500,000. This cost include initial payment of 1 million. So initial payment means the down payment. The down payment in a lease is a investing activity. Down payment 1,000. Then you will get your net cash flow from investing activity. That will be 1,200. Answer number 2. Answer number 2. 19th one. Which of the following statement is correct as per LKAS 8 accounting policies, changes in accounting estimates and errors? Okay. A. Accounting estimate arise due to uncertainties inherent in the business activity. Correct. Why do we assume stuff? Why do we estimate stuff? Because there are uncertainties. We are not sure how much will it actually be. So you estimate it. You predict it. B. Accounting policies should always be selected by applying the guidelines prescribed in the accounting standards. No. You can either select the policy by following the standard, or if the standard is not telling a way to select the policy, you can use the managerial judgment. The managers of the business can make a judgment and select the policy accordingly. Okay. Then C. The effect of accounting estimate should be adjusted in the profit and loss in the current period or in the current and future period. Correct, right? Accounting estimate should be adjusted either in the current period for things like bad debt, right? You will have to adjust it only in that affecting year. And for things like depreciation, provision for doubtful debt, it will affect the current year and future periods. So that is correct. So A and C, answer number 4. 20th one. Which of the following statements are correct as per LKS 37, provision, contingent liability and contingent asset? Okay. A provision is a liability of uncertain timing or amount. Correct. That's the definition of provision. B. A legal obligation is an obligation that derives from a contract, legislation, or other operation law. Correct. That legal obligation are those that come from a law or any contract. Then an entity shall not recognize contingent liability and contingent asset in financial statement. Correct. We don't record contingent asset and liability in financial statement. So all A, B, C are correct. Answer number 5. Then 21. Which of the following statements are correct as per SLFRS 16 leases? At the commencement date of the lease, the lessee should measure the right of use asset at its fair value. Is that true or false? Is that true or false? Correct or wrong? It is false. Okay, wrong. We measure at what then? At commencement date, you have to measure at the cost of it, not the fair value of it. Okay. Then B. At the commencement date of the lease, the lessee should measure the lease liability at the present value of lease payments that are not paid at the date. So, how do you find your lease liability? By finding the present value of your lease installment, right? The lease installment multiplied by discounting factor, you get the present value of lease payments. You add all that, you get the lease liability. That is correct. C. The present value of the lease payment is calculated using the interest rate implicit in the lease if it can be readily determined. So how do you find the present value? Present value equals installment into discounting factor. How do you find the discounting factor? Through the interest rate, or the discounting rate. So that is correct. B and C, answer number 4. Then 22. Some balances of Gayanta PLC as at 1st of April 2023 are given below. Stated capital 7,500, retained earnings 3,500, dividend payable. Now, normally we don't have an account called dividend payable. Okay, but somehow in this question, they have recorded as dividend payable. Okay, so they have allocated a portion and already kept under dividend payable. So, what are they asking? The retained earnings, no, will prepare the retained earnings account. Retained earnings. Opening retained earnings is 3,500,000. Okay. On 1st of April 2023, the company capitalized retained earnings. Capitalized retained earnings by issuing 1 share for every 5 shares held on this date at 120 per share. Okay. Now here they have ordinary shares worth 7,500,000. Each share is worth 100 rupees. And how much shares do we have in total? 7,500. 7,500,000 divided by 100. You have 75,000 shares. Okay. Now you're going to capitalize retained earnings for 1 share for every 5 shares. And how much bonus shares you're giving? 75,000 divided by 5. That is 15,000 shares. You're going to give 15,000 free shares at 120 rupees into 120, that is 1,800,000. So you can debit that here. Stated capital 1,800,000. Okay. Then during the year, the company paid the dividend payable as at 1st of April and the interim dividend of 500. Now they are paying the dividend payable. The double entry for that will be dividend payable debit cash credit. It won't affect the retained earnings. They have already deducted this. Then interim dividend, you have to deduct cash 500. Now you can balance it off and find the BCD. 3,500 minus 1,800 minus 500. BCD 1,200. That is, wait. I haven't added the profit, right? The profit of the company for the year was 1,400. So you have to credit the profit 1,400. Yeah. Yeah, okay. I'll explain that. So 3,500 plus 1,400, 4,900. 4,900 minus 1,800 minus 500, 2,600. Answer number 3. Yes, Shazra. So the double entry for the dividend payable paid will be dividend payable account debit, cash credit, not retained earnings. Okay. Now, how have they provided this dividend payable? Once last year or something, maybe they have done like this. Retained earnings debit, dividend payable credit. That's how they recorded this. So they have already deducted from retained earnings, and now they are paying it. It will be dividend payable debit, cash credit. Got it, Shazra? So it won't again affect the retained earnings. Okay. So Artika, how did I get that shares? Now see here. We totally have shares worth 7,500,000, right? Yeah. So that means 7,800,000. One share is worth rupees 100. Then how many shares do they have? Then how many shares do they have in total? They have 75,000 shares. Okay. Now what they are doing, they are going to capitalize retained earnings by issuing one share for every five shares. Okay. For one share for every five shares, they are going to give free shares. Okay. That means for a person who have five shares, they are going to give one free share. How do you find that one share is to five shares? So now total you have 75,000 shares. How much is 1 over 5 of that? That is 15,000, right? So it's simply 1 over 5 into 75,000. 1 over 5 into 75,000 is 15,000. They are going to give 15,000 free shares. Did you understand that, Atika? How did you get that 100? 100. This 100. Here they're telling, right? Share issued at 100 rupees each. They're saying one share is 100 rupees. So totally we have 7,500,000 worth shares in rupees. If you divide by 100, you can find out how much is the number of shares, right? Okay. Okay. All right. And Kashu, haven't they paid dividend 100? No, no, no. They have paid. They paid this payable amount and the dividend for this year. See here, they're saying the company paid the dividend payable as at 1st of April. That means they paid this and also this 500 interim dividend for the year. Got it, Kasha? Not 100. Right? So the closing retained earnings balance is 2,600,000. Okay. Then 23. The quick asset ratio of a business as at 31st March 2024 was 1:1. The business is considering the following actions to improve the quick asset ratio. Which of the above action would lead to improve the quick asset ratio? Okay. To pay an insurance premium in advance. What will happen? Will the quick asset ratio increase or decrease? Insurance premium in advance. Now it will decrease, right? Quick asset ratio, quick asset is to current liability. Now here 1:1. Now let's say our quick asset is 100 and current liability is 100. Okay. Now if we are paying an insurance premium in advance, a prepaid expense, what will happen? Our cash will decrease and prepaid expense will increase. Okay, prepaid expense is not a part of quick asset, right? We remove that. Now cash is decreasing. Let's say we are paying a prepaid expense of 20. And now our quick asset will be 80 and current liability will be 100. It will be 0.8 is to 1. So it will reduce our quick ratio. Okay. B. To sell the existing inventory on credit. To sell the existing inventory on credit. Our stock will reduce and our debtor will increase. Okay. Now stock is not a part of quick asset. Okay. But debtor is a part of quick asset. So if the debtor value increase, quick asset will increase. Therefore, quick ratio will increase. See, to settle the existing short-term liability using cash in hand, what will happen? Increase, decrease, or no change? Due to the third one, what will happen? Increase, decrease, or no change? To settle the existing. So, Shadra, inventory is not a part of quick asset, right? But then what is increasing here? What's the quick asset that is increasing here? Data. Okay. So if the data increases, the quick asset will increase, right? Data is a part of quick asset. Got it? So if the data is increasing, quick asset will increase. Therefore, the quick ratio will increase. Okay. C. Can you tell me for C what will happen? Increase, decrease, or no change? So no change. In this situation, it's a no change. Here say quick asset is to current liability. We'll say a quick asset 100, current liability is 100. Let's say we settled a trade payable of 20. Then quick asset cash will reduce by 20, then quick asset will be 80. Liability will reduce by 20, the trade payable, current liability also will be 80. Then it will be 1:1 still, no change, right? So here, no change. To sell existing inventory for cash. If you sell inventory for cash, your quick asset will increase. Your inventory decreasing. Inventory is not a part of quick asset. On the other hand, your cash is increasing. So if the cash increases, your quick asset will increase. Therefore, quick asset ratio will increase. Okay. Then answer is B and D. Answer number 3. Then 24. Which of the following activities can be considered as management accounting functions of a firm? Determine the cost of a product or service, it is management accounting. Analyzing the behavior of cost when the activity level is changing, these are management accounting. Providing financial information for investors and lenders, that is financial accounting. Analyzing the cost volume profit relationship, marginal costing, that is management accounting. A, B, and D, answer number 3. 25. Which of the following statement is correct in relation to inventory management in a firm? Okay. The EOQ of an inventory item is the reorder quantity at which the total of its annual ordering cost and annual holding cost is minimum. Correct, right? EOQ is the amount of inventory if we order. Okay. If we use that as our reorder quantity, if we order the EOQ at each order, that is when our total cost will reduce. Total cost is equal to annual ordering cost plus annual holding cost. Correct. The reorder level of an inventory item is calculated by multiplying maximum consumption by maximum lead time. Correct, right? Reorder level equals to maximum consumption into maximum lead time. C. Cost formulas are used to measure the cost of an inventory item when specific identification method cannot be used. That is correct. Okay. We use FIFO or VAT if we can't specifically identify the cost of the inventory. So A, B, and C, answer number 5. Then 26. Employee related expense and EPF payable. So employee related expense will be employee related expense equals to gross salary plus EPF expense plus ETF expense. Gross salary will be basic salary plus allowance, that is 10,000, right? That will be 10,000. Gross salary 10,000. Then EPF expense means employer contribution. Here, the EPF employee and employer and employee contribution are 15% and 10% respectively. ETF is 3%. EPF and ETF contribution are calculated based on gross salary of employee. Then EPF expense, the employer contribution will be 15% of 10,000, that is 1,500. And ETF expense will be 3% of gross salary. 3% of 10,000 is 300. Then how much will be your employee related expense? 11,800. 11,800. Then EPF payable. EPF payable will be both employer contribution and the employee contribution. both the employer and employee's contribution should be given to the EPF department. So employer contribution 1,500, employee contribution will be 10,000 of gross salary, 1,000, that will be 2,500. So employee related total expense 11,800, EPF payable 2,500, answer number 5. Okay, then 26. The cost of production per unit and total fixed cost for the next period and the contribution per unit. Okay, cost of production per unit. Direct raw material cost per unit 2 kilograms into 300 per kilogram. Raw material 2 kilograms into 300 per kilogram, that will be 600. Then direct labor 2 hours into 200. Direct labor 2 hours into 200, that is 400. That will give you your prime cost as 1,000. Prime cost will be 1,000. Then for that you have to add your production overhead. Production overhead absorption rate is 300 per direct labor hour. Now for 1 unit to produce, you need 2 direct labor hours, right? So 2 hours into production overhead, 2 hours into 300 per hour, right? Yeah, 300 per hour, that will be 600. And then, yeah, cost of production, right? Okay, therefore, production cost per unit will be production cost per unit will be 1,600. Okay, then next, total fixed cost. How do you find the total fixed cost here? It is estimated that 50% of the production overheads and 75% of non-production overheads are variable cost. Okay, first of all, production overheads. How much will be the total production overhead? See here, the production overhead for 1 unit we found as 600. We are producing 20,000 units. Then what will be the total production overheads? 20,000 units into 600 per unit, that is 12 million. 12 million. Okay, then they are saying it is estimated that 50% of the production overhead are variable. Then fixed will also be the remaining 50%, right? And how much is that? That will be 6 million. Then non-production overhead is given as 8 million. 8 million. They are saying 75% of non-production overhead are variable. Then how much will be fixed? 25%. That will be 25% of 8 million, 2 million. Then your total fixed cost will be 8 million. Okay. Cost of production per unit 1,600. Total fixed cost 8 million. That is answer number 3. Then 28. The contribution per unit of this product. How do you find a contribution per unit? Selling price minus variable cost. Okay. So how do you find selling price? Profit markup on total cost 25%. Okay. Production cost per unit is 1,600. And now we need to find non-production overhead per unit. Non-production overhead per unit. Total non-production cost is 8 million. We are producing 20,000 units. Then for 1 unit, the non-production overhead is 400. Then the total cost for a unit will be 2,000. Now we are adding profit 25% on total cost. Profit 25% on total cost, that will be 500. Then your selling price will be 2,500. Now to find contribution per unit, that is selling price minus variable cost. Now how much will be your variable cost? Now entire prime cost is variable cost, right? Prime cost is variable cost. Prime cost 1,000. How much is your variable production overhead? See, variable production overhead is 50% of the total production overhead, right? For one unit, the production overhead is 600. So 50% of that is 300. And they are saying 75% of the non-production overhead is variable. Non-production overhead per unit we found as 400. Then 70% of that is 300 variable non-production overhead. Then total variable cost per unit will be, am I fast? Okay, sorry. Total variable cost per unit will be 1,600. Okay, variable cost 1,600. Then contribution per unit will be 2,500 minus 1,600. That is 900. Answer number 3. All of you understood that? Anyone who didn't understand because I was too fast? If there's anything that's not clear, let me know. Okay. How you get variable cost, just this total variable cost per unit. So here this entire prime cost is variable cost, right? Yes or no? This direct material and direct labor, those are variable cost, right? Okay. So prime cost is a variable cost, 1,000. All right. Now production overhead. See here, it is estimated that 50% of production overhead and 75% of non-production overhead are variable cost. Now, the production overhead per unit we found as 600. Hope you understood how. So 50% of that will be variable. So variable production overhead will be 300. Okay. And 75% of non-production overhead is variable. Non-production overhead we found as 400 rupees for one unit. So variable cost included in that will be 75%, 300. So variable non-production overhead is 300. Total variable cost per unit is 1,600. Did you understand that, Shastra? Okay. Then 29. The activity level of a manufacturing company is 100,000 units. The following information relates to the year ending 31st March 2024. Okay. So 12,000 profit. Okay. Sales, right. Sales minus variable cost equals contribution. From contribution, if you deduct total fixed cost, you will get the profit. Sales is 12 million. Total fixed cost is 3 million. Profit is 2 million. If the profit is 2 million and total fixed cost is 3 million, how much will be the contribution? How much will be the total contribution? 2 million plus 3 million, that is 5,000. Then the variable cost will be 12 million minus 5,000, that is 7 million. 7 million. Now they are asking for variable cost per unit. Variable cost per unit. Total variable cost I found as 7 million divided by we are producing 100,000 units. That means the variable cost per unit will be rupees 70. Then how do you find break-even point? Break-even point equals total fixed cost divided by contribution per unit. Total fixed cost is 3 million. Then how much will be the contribution per unit? Here total contribution is 5 million. Then divide by 100,000 units. That will be rupees 50. Then your BEP will be 60,000 units. So 70 rupees and 60,000 units. Answer number 5. Answer number 5. Then the last MCQ. A firm is considering a project to invest in a machine with a useful life of 5 years. The estimated cost of this machine is 1 million. An annual net cash inflow of 200,000 is expected from this project. The expected rate of return of this project is 10% and the NPV of the project is negative. Okay. A. The present value of total future net cash inflow of this project is lower than the initial investment. Now, how do you find your net present value? Net present value equals present value of net cash flows from the year 1 to year 5 minus the initial investment. Initial investment. Okay. Then now, if your NPV is negative, which one would have been higher? The present value of the cash flows from year 1 to year 5 totally or the initial investment? If your NPV is negative, that means your initial investment is higher than the present value of the net cash flows of year 1 to year 5. Okay, so this one is correct. The present value of total future cash flow is lower than the initial investment because they are saying the NPV of this project is negative. If the annual net cash flow of the project is increased to 250,000, its payback period will be 4 years. The payback period, initial investment is 1 million. And if the annual net cash flow is 250, that means it will take you 4 years to recover the investment. So that is also correct. See, when the expected rate of return of this project is higher than 10%, its NPV is positive. Now here they are saying at the rate of return of 10%, your NPV is negative. Now can you all tell me, if you increase this what expected rate of return from 10% to let's say 15%, what will happen to your NPV? What will happen to your NPV? It will decrease further, right? We studied if the rate increases, NPV decreases. Okay, so if your expected rate of return increases, okay, your NPV will decrease even more. Now it's already negative. If you increase the rate, it will decrease further. So this is wrong. They are saying when the expected rate of return is higher than 10%, NPV will be positive. No, it will be even more negative. So the correct statement is A and B only. Answer number 2. Okay, so we are done with MCQ. Another 20 more questions. Okay, 31. Several activities of a firm are given below. We should write the environmental factor. A. Selection of appropriate accounting policy in preparing general purpose financial statement that is based on professional environment. Assessment of tax liability in line with the provision of Inland Revenue Act. All the act numbers are legal environment. Use of computerized accounting software package, technological environment. Revaluation of building in the change due to the change of market price, that is economic environment. Okay, 32. They have given some opening and closing asset and liability. The following transactions relating to the owner of the business have taken place during the year and they have been properly recorded. Okay. First of all, A part, state the impact of the above two transaction with value. Okay. The owner paid 50,000 to credit of the business using his personal fund. When the owner pays something of the business from his personal money, that's the additional capital. Therefore, equity will be plus 50. Here he is paying a creditor, therefore liability will be minus 50. Second one, the owner obtained goods costing 100,000 for his personal use. So that will be asset minus 100, drawings will reduce equity, equity minus 100. B, profit of the business for the year ending 31st March 2024. Profit equals to closing net asset minus opening net asset plus drawings minus additional capital. Closing equity will be 800 minus 450, that is 800 minus 450, that is 350. Opening equity will be 600 minus 325, that is 275. Drawings is 100,000. Additional capital is 50. Your profit will be 350 minus 275 plus 100 minus 50, that is 125. Profit for the business 125. Okay. Then 33 and 34. Prime entry book. Purchase. Okay. The following four transactions have taken place in a furniture manufacturing business. So, purchase of timber on credit. Now, furniture manufacturing business, purchasing timber will go on credit, will go to the purchase journal. Purchase journal. Purchase of a timber processing machine on credit. Purchasing a property, plant, and equipment on credit will go to the general journal. General journal. Sold furniture with a list price of 5,200 for cash, subject to a trade discount of 200 on cash, that is cash receipt journal. Settle the total amount due to custom, subject to a cash discount of 100,000, that will be cash payment journal. Okay. 34. Write the journal entries to record the above transaction C and D. Okay. C. Sold furniture with a list price of 5,200 on cash, subject to a trade discount of 2,000. Then what will be the selling price? What will be the sales value? 5,200 list price minus trade discount. The sales value will be 5,000. We ignore the trade discount, right? Correct. 5,000. And what will be the double entry for that? Cash control account will be debited by 5,000 and sales will be credited by 5,000. Then D, settle the total amount due to Kasun to a cash discount of 100. How much do we have to pay to Kasun? We have to pay 2,500,000. So then it will be Kasun, trade payable, Kasun, debit 2,500,000. You're getting a discount of 100. So discount received will be 100,000. Then you have to pay only 2,400. Cash control account credit 2,400,000. Okay. Then 35. State the type of account for each of the following general ledger account. Discount received is an income account. Drawings is an equity account. Provision for compensation is a liability. Accumulated depreciation is a negative asset. So you just say asset. Okay. 36. Complete the following statement with the most appropriate accounting concept. Okay. Only the transactions with monetary value occurred in a firm are required to record in books of accounts as per money measurement concept, right? Money measurement concept. Based on money measurement concept, we record only transactions that can be measured in a rupee value. B. The blank concept requires the firm to report all the information in the financial statement which are useful for the stakeholders to make decisions. That is the disclosure concept. The disclosure concept only says provide all the information that is required to make decisions by the stakeholder. C. The cost of goods purchased during the current year but not yet sold are excluded from cost of sale. we deduct the closing stock under the cost of sale because of matching concept, right? Because we didn't sell it, you can't recognize that as an expense. Therefore, you remove that. That is matching concept. D. The cost of relatively low value equipment with a useful life of more than 1 year is treated as an expense. Now, for example, if you take a stapler has features of non-current asset. You can use a stapler for more than a year, but will you consider it as a non-current asset? No, you will consider it as an expense because the value of it is very small. Maybe it is like 300 rupees or something. So because of that, you consider it as an expense because of materiality concept. Materiality concept because it's not material, it's not important. Okay, 37. State with the value whether each of the following transactions of a sport club occurred during the year leads to an increase or decrease in accumulated fund. Okay. Subscription receivable was written off during the current year. That is an expense that will reduce your surplus. Therefore, it will reduce your accumulated fund. Decrease by 20. B. Rented out the sports ground for 250,000 for a cricket tournament held during the year and received 200 in cash. What will happen? It will increase accumulated fund or decrease accumulated fund? The B part. Will it increase or decrease? It will increase by how much? Yeah, it will increase by how much? Now see here. Your income and expenditure account, you're preparing on cash basis or accrual basis. You're preparing based on accrual basis, right? Now you have rented out the sports ground. Okay, you have rented out the sports ground. Then what is the total income amount you're supposed to get? You're supposed to get 50,000. You're supposed to get, sorry, 250,000. Okay, but you have got only 200. But then what will you record as income? What will you record as income? The actual amount you're supposed to receive, right? That is 250,000. Okay, this 250 is your income. Out of that, 200 is received and 50 is receivable. Okay, is that clear? Then 38. Complete the following statement in relation to partnership using the appropriate terms. Okay. The variable equity of partnership is recorded in the partners. Variable equity means the equity that changes from time to time. That is recorded in partners current account, right? Partners current account. B. When partners retire from the business, they are entitled to receive a 5% interest per annum on the unsettled balance as per the what section? Section 42. Correct. Section 42. Section 42 is only telling to pay 5% interest on retired partners loan. C. The maximum number of partners of a partnership business is limited to 20 as per which act number is telling is limiting to 20 the number of partners. The Companies Act number 7 of 2007, right? So you should write number 7 of 2007 Companies Act. Companies Act. Don't just say Companies Act, it will be wrong. Okay. 39. Amal and Bimal carried out a partnership without a written agreement. Chamara joined the partnership on 1st of April 2024 by investing 1 million in cash and land worth 2 million. On this date, the goodwill of the partnership was estimated as 1,200,000. The new partnership is also continued without a written agreement. Okay. We should write a double entry for contribution of Chamara to the capital of the partnership. Chamara is contributing 1,000 in cash, 2,000 in land. Then that will be cash control account, debit 1,000. Land will be debit 2,000. Then partners capital account, Chamara will be credited by 3,000. Then goodwill of the partnership. Now, if if they don't have a written agreement, then you should share the goodwill equally, right? Can't we just right? No, Atika, then it's wrong. Huh? You won't get the marks because where are you crediting? What is the account? It is partner's capital account. If you just say Chamara, it is totally wrong. Okay, you should write the account name. Now in goodwill also, you can't just say goodwill new ratio debit old ratio credit. You should say partner's capital account debit. Okay, partner's capital account debit. Okay, now new ratio will be between Amal, Bimal, and Chamar. Okay, the goodwill is 1200. You are sharing now. No written agreement means profit loss sharing ratio will be equal, and that will be 1200 if you divide among three of them. 400, 400, 400. Debit, debit, debit. Then credit based on old ratio. Partners capital account. Who are the old partners? Credit only Amal and Bimal. Amal and Bimal. 600 and 600. Okay. There's an alternative way to show this. You can say Amal debit 400 and Amal credit 200, Bimal credit 200, Chamar debit 400. Okay. Here you can get the net impact. You can say partners capital account, Chamar debit 400. You can see Amal's credit balance is higher than debit balance by 200. So Amal credit 200, Bimal also credit 200. This answer also correct. This answer is also correct. Okay. Then 40th one. Complete the following statement as per the conceptual framework for financial reporting. The equity is blank interest. Equity is what interest? Equity is correct. Residual interest. Residual interest. In the asset of the entity after deducting all the liabilities. B. A liability is a present obligation to transfer an liability is the present obligation to transfer an economic resource as a result of past event. Economic resource. C. Income is the increase in asset or decrease in liability that result in increase in equity other than uh, due to the contribution from equity holders. Okay. Then expense is the decrease in asset or increase in liability that result in the decrease in equity other than those relating to distribution to equity holders. The definition of expense is the opposite of the definition of income. I think now in 2024 they asked the definition of income. For our year 2025 they gave the definition of expense. So y'all also might get some. I think y'all might get definition of asset if I'm not wrong. Yeah. Okay. Then 41. State whether each of the following statement is true or false as per LKAS 2A. Inventories are measured at cost and NRV value, whichever is lower. That is true. Net realizable value is the estimated selling price in the ordinary course of business minus, less means minus, estimated cost of completion and estimated selling price. Correct, right? NRV equals estimated selling price minus estimated selling expense plus cost of completion. Therefore, this is true. An entity should use the same cost formula for all inventories having similar nature and use. For example, uh, let's say Lux soap and Velvet soap. Okay, both of these are similar products having the similar nature and use. Okay, both Lux and Velvet are soap, right? Used for the same purpose. Therefore, you can't use FIFO for Lux and use VAC for Velvet. You should use the same cost formula for the products with similar nature and use. Therefore, this is true. D. Out of the FIFO method or VAC method, the one that gives the lower value should be used in measuring cost of inventory item false, right? You don't select out of FIFO and VAC which is lower and use that method, right? FIFO and VAC are policies. You will seriously make the decision and only select one out of that to one. Find the cost of your inventory. Then 42. The financial statement of Saman PLC for the year ending 31st March 2024 were authorized for issue by the directors on 30th of June. On 30th of June only you're authorizing it. Okay. What should we do? We need to find out the non-adjusting events. Okay. A case was filed on 10th of April by a customer. See here, a case was filed on 10th of April. So that is after the reporting period, right? So this is a non-adjusting event. 2. A factory with a carrying amount of 9 million destroyed. That is non-adjusting. 3. A debtor was declared bankrupt on 31st May. So it is before the authorization date. Amount receivable from this debtor as at 31st March 2024 was 3 million. That means he was there during the reporting date as well. So only this is a adjusting event. So non-adjusting events are 1 and 2. 1 and 2 are non-adjusting events. Okay. Why not 1? Why 1 is not adjusting? See here, the case was filed on 10th of April, right? For a compensation adjustment to be adjusting, the file should be file should be case. No, the case should be filed during the reporting period, and the court should confirm the amount to be paid after the reporting period before the authorizing date. Those are only adjusting. Now here, even though the court order was given before the authorization date, the case was filed on 10th of April, which is after reporting date. So this is connected to the next year, not the current year. You will not take it as an adjusting event for the current year. Is that clear, sir? So now you know 4 adjusting events, right? Okay. The compensation, bad debt, NRV, and if you identify the cost of PPA after reporting period. These are the only 4 adjusting events. For these to be adjusting event also, there should be 2 conditions fulfilled. One is it should provide evidence that that information is connected to the reporting date, and that should happen before the authorization date. Okay, those 2 conditions also should be satisfied. In the first one, the second condition is satisfied, but the first condition is not satisfied. Therefore, it is non-adjusting. Okay. Then B, the correct total asset and total liability after considering the above adjustment. Okay. Now they have given the assets that they have calculated is 60 million. Now the only adjusting event is the third one, right? Third one, we should adjust this debtor as bad debt. Okay, then that will reduce the value of our debtor. Then what will be our total assets now? 60 minus 3000. The asset will be 57. Okay. Will there be any change to liability? Now the first and second are non-adjusting events. Okay. Uh, Third one doesn't affect liability anyway. The liability won't change. Total liability will be 25. It will not change. Okay. Then 43. Chatu PLC purchased a machine for 6 million on 1st of April 2021 and estimated its useful life as 5 years. The company depreciate the machine on reducing balance method at 40% per annum. On 1st of April 2023, the company revised the depreciation method of the machine to straight line method and estimated its residual value as 0. There is no change in useful life of the machine estimated. Okay. Depreciation expense for the year ended 31st March 2022. Okay. Now, 2022. Okay. 31st March 2022. Now, if you're calculating depreciation on reducing balance method, you have to calculate depreciation on the carrying value. Okay. We purchased this machine on 1st of April 2021. Then what will be the carrying value for as at 31st March 2000? Sorry. The carrying value for that year as at the opening date is still 6 million, right? You purchased it on that date. So 6 million into 40%, that will be 6 million into 40%, that will be 240,000. 240,000 will be the depreciation. No, wait. 40%. Okay, that is 2,400. Then, what will be the depreciation for 31st March 2023? How do you find that? Okay, first of all, what is the carrying value of the machine as at the opening date of this year? That is 1st of April 2022. What will be the carrying value of the machine? The cost is 6,000 minus opening accumulated depreciation 2,400. The carrying value for year 2 will be 3,600 into 40%. The depreciation for year 2 will be 1,440. Okay. Depreciation expense for the year ended 31st March 2020 is 2,400,000. Accumulated depreciation is at 31st March 2023. That's the total of these two. That is 3,840,000. And then to find a depreciation expense for 31st March 2024. Now in this year only that change is happening. From residual value, they are changing to straight line method. If there is a change that is happening, you should use this formula. Depreciation equals cost minus accumulated depreciation minus residual value divided by remaining useful life. The cost is 6 million. Accumulated depreciation for the last 2 years is 3,840,000. Can you all tell me what will be the remaining useful life? How much will be the remaining useful life value? The remaining useful life value? Correct, perfect. Now here the useful life is given as 5 years. Okay, we have already depreciated for 2 years. The remaining useful life will be 3 years, right? Then depreciation will be 6,000 minus 3,840 divided by 3, that is 720. The depreciation for year 3 will be 720,000. Then 44. State whether each of the following statement is true or false as per SLFRS 15, revenue from contracts with customers. A. An entity should recognize revenue when it satisfies a performance obligation by providing a promised good or service to customer. True, right? According to SLFRS 15, we can recognize revenue only if the performance obligation is satisfied. B. The transaction price is the amount of consideration that the entity has received in cash in exchange of goods and service. That is false. What is transaction price? Transaction price is the amount of consideration that an entity is expecting to receive in exchange of goods and service, not received. Sometimes you won't get the entire amount at once as cash, right? Sometimes you might receive it later. So the amount you're expecting to receive only you consider as transaction price. C. The consideration promised in a contract may include fixed amount, variable amount, or both. No, that is true. So normally when you sell a good, the goods may be a fixed amount. The variable amount may be the services. For example, let's say annual service is 100,000. If you're taking 1 year of service, that will be 100. 2 year of service, 200,000, right? So normally the goods are of fixed amount, services are variable amount. You can have both as well in a contract. Then D, the performance obligation can be satisfied at a point in time or over a period of time. Can you all tell me for what will we satisfy at a point in time? Goods or service? The performance obligation will be satisfied at a point in time for goods or service. For goods, right? At a point in time is at a particular time. Now, if you give the goods, let's say now the time is 4:57. I'm giving the goods to you at 4:57. That is a point in time. Okay. But over a period, then what about services? Services will be provided over a period of time. For example, if I'm providing maintenance service, I might start the maintenance at 5 o'clock, okay, and end it at 6 o'clock. That's over a period of time. Not only that, sometimes you might give service year by year. So those are over a period of time, not at a point in time. So that is true. Okay, performance obligation can be satisfied either at a point in time for goods or over a period of time. That's for service. 45. Dividend per share, profit after tax, and interest coverage ratio. So, dividend per share will be equal to dividend paid divided by number of shares. Dividend paid is 300,000. Number of shares 60,000. Then dividend per share will be rupees 5 per share. Dividend per share will be rupees 5. Profit after tax you can find through the EPS ratio. EPS equals profit after tax divided by number of shares. EPS is 30 rupees. Profit after tax we don't know. Number of shares is 60,000. Therefore, profit after tax will be 60,000 into 30. That is 1,800,000. They are asking the answer in thousands, therefore 1,800. Then interest cover ratio. Interest cover ratio will be profit before tax plus interest divided by interest. Profit after tax is 1,800. The income tax is 700. Then profit before tax will be 1,800 plus 700. That is 2,500. And the interest expense is 500. Divide by 500. Interest cover will be how much? Interest cover will be 6 times. Interest cover ratio will be 6 times. Okay. Then 46. The following cost items relate to a firm which assembles bicycles using imported components. Classify each of these cost items as direct or indirect and variable or fixed. Okay. Cost of tires and tubes. Tires and tubes, those are raw material. Those are direct expenses. Are they variable or fixed? Variable. Monthly wage of assembly worker. Assembly worker is a direct labor, but his monthly salary, monthly wage now, it is a fixed expense. Monthly salary of a assembly division supervisor. Supervisor is a indirect labor. Monthly salary, it is fixed. Cost of grease and oil. Grease and oil, those are indirect material. However, those are variable. But it can change, right? The amount of grease and oil you use can change from the number of units. 47, true or false? State whether each of the following statement relating to cost of a manufacturing business is true or false. Okay. The cost that can be identified specifically with a cost object is known as overhead. They are telling overhead means the cost that can be identified specifically for one unit. True or false? That is false, right? Overhead we can't find per unit directly. False. Prime cost only you can directly identify per unit. Okay. B. Stores ledger records both quantity and value of raw material items. Okay, stores ledger. Stores ledger. Where to write that? Okay. Stores ledger is only that account we prepare receipt, balance, issue. Okay, FIFO and WAC we prepare stores ledger. In the stores ledger, we show the value in rupee, the inventory value in rupees, and also the number of units available, right? Then what is that accounting record where you will show only the units in which record. Now in stores ledger, we show the value of inventory and units also. Where do we show only units? Bin card. In the bin card, we show only the number of units, the movement in number of units. How much came in, how much went out. Okay. Why is the first? So this is correct. So why is the first one wrong? The cost that can be identified specifically with a cost object is known as overhead. Cost that can be identified specifically. That means you can directly identify per unit how much. Overheads, can you directly identify per unit how much? Yes or no? You can't, right? Only prime cost. Prime cost only you can directly identify how much is it per unit. Overheads you can't directly find. Therefore, it is false. Got it, Shastra? Then see, fixed overheads do not change due to an increase or decrease in production level within the relevant range. Correct, right? Fixed costs don't change due to an increase or decrease in the number of units you produce within your capacity. D. Wages paid to machine operator on output basis are classified as direct labor cost. True, right? Paying the See, for machine operator, even if you pay per unit or even if you pay a monthly salary, machine operator's salary is a direct labor cost. Okay. 48. A company manufactures a single product. It has two production cost centers. Budgeted information relating to these cost centers is given below. Okay. They're telling to find the overhead absorption rate. So here they have given the overhead absorbed per unit and the processing time per unit. And what will be the OAR? OAR means for 1 hour how much, right? So you can find it using this equation. Overhead absorbed per unit will be equal to overhead absorption rate into hours per unit, the processing hours per unit. Now here, overhead absorbed by 1 unit is 100 rupees. To produce 1 unit of in the cost center one, it takes 2 direct labor hours. Then what will be the OAR? How much will be the OAR of cost center one? How much will be the OAR? That will be 50 per hour, right? OAR will be rupees 50 per hour. 50 per hour into 2 direct labor hours only they got the overhead absorbed per unit as 100. Okay. Then for cost center 2, the same thing. Overhead absorbed is 240 per unit. Okay. To produce 1 unit, the processing time is 3 machine hours. Then what will be the OAR? How much will be the OAR? That is 80, right? 80. OAR will be 80. Okay. B. Total budgeted overhead. Now they are trying to find a total overhead. How can you find a total overhead? Total overhead will be equal to OAR into total number of hours. Okay. See here, OAR of the cost center one we found as 50 into the total hours spent in the cost center one is 50,000 machine hours. So total hours spent 50,000 machine hours. For 1 hour, the OAR is 50. Then the total overheads of the cost center one will be 50,000 into 50. That is 2,500,000. So you can hear they're saying to write in thousands, 2,500. Then cost center 2. Cost center 2 OAR is 80. They are using machine hours, 20,000 machine hours. total overhead will be 20,000 into 80, 1,600,000. That is 1,600. Hope you have got that. Then the last two questions. 49. Jaya PLC is planning to produce a single product. The estimated activity level of the company is 18,000 units. The company's expected break-even point is 10,000 units. The expected selling price is 80 rupees per unit. Contribution to sales ratio is 25%. Okay. Selling price is 80. Out of that, if 25% is contribution, how much will be the contribution? How much will be the contribution? 80 into 25% is 20. That means the remaining 75% is variable cost, right? And how much will be the variable cost? 80 minus 20, variable cost per unit will be 60. Variable cost per unit 60. Next, they are trying to find the total fixed cost. You can find the total fixed cost using the BEP equation. Break-even point equals total fixed cost divided by contribution per unit. BEP is given as 10,000 units equal total fixed cost we don't know. Contribution per unit we found as 20. Therefore, total fixed cost will be equal to 10,000 into 20. That is 200,000. So total fixed cost 200. Then total cost at activity level of 18,000 units. Total cost, how do you find? Total fixed cost plus total variable cost. Total fixed cost is 20,000. Sorry, 200,000. Total fixed cost will be how much? Per unit, total variable cost. Per unit, the variable cost is 60. Then for 18,000 units, that will be 1,080,000. Then the total cost will be at 18,000 units, 1,280,000. 1,280,000. Writing thousand. Then the profit if the activity level is 15,000 units. And to find the profit, you can use this equation. Expected unit equal total fixed cost plus profit divided by contribution per unit. Expected unit 15,000, total fixed cost 200,000, profit we don't know, contribution per unit is 20. Then profit will be equal to 15,000 units into 20 minus 200,000. 15,000 units into 20 is 300,000 minus 200,000 fixed cost. Your profit will be 100,000. 100,000. 100. Okay. Then the last question. A firm is considering to purchase an eco-friendly machine for a cost of 5 million. The useful life and residual value are 10 years and 400,000 respectively. This machine is depreciated on straight line method. The annual net cash inflow from this machine is 625,000. Payback period. Payback period equals initial investment divided by annual net cash flow. Initial investment is 5 million. Annual net cash flow is 625,000. Therefore, the payback period will be 8 years. Payback period will be 8 years. Yeah, sure. Is it working? Okay. D part. The profit if the activity level is 15,000, right? Do you know this equation? You can find the profit through this equation, right? The expected units equal total fixed cost plus profit over contribution per unit. Okay, see here. Then 15,000 multiplied by 20 is 15,000 into 20 is 300,000. Total fixed cost is 200,000, right? Total fixed cost 200,000. Then profit is 100,000. Okay, alright. Then 50th one, accounting rate of return. Accounting rate of return equals to, okay. Accounting rate of return equals average profit divided by average investment. Okay. How do you find your profit? Profit equals to annual cash flow minus what? If you deduct what from the annual cash flow, you can find your profit. You have to deduct your depreciation minus depreciation. Annual cash flow is given as 625,000. Yeah. Annual cash flow is given as 625. Depreciation, how do you find? Cost is 5,000 minus residual value 400 divided by useful life 10 years. Depreciation will be 460 minus 460. How much will that be? 625 minus 460, 165 into 100. So 165 divided by average investment will be how much? Initial investment is 5 million. Then at the end of the useful life, the residual value will be 400,000. Average investment will be initial investment plus residual value divided by 2. So that is 5,000 plus 400, 2,700, 2,700,000 into 100. ARR will be 165 divided by 2,700 into 100. That is 6.11%. That's your answer. 6.11%. Okay. So that is the 2025 paper. We are done. To be honest, I think 2024 paper was the easiest paper in the past few years. Okay, it was the least time consuming paper uh, from the past few years, and 2025 and 2023 were more time consuming than this. Okay, so then that's all for today. Thank you for joining. If there's any doubt, you all can ask.